for the entire year. And from that perspective, it is all the more important. And also, what is the 1 year forward guidance going ahead, that is for FY26. So, in order to demystify how the earnings were and what's the forward guidance, today we have with us Mr. Harshad Boravake. Harshad is head of research at Mirae Asset Mutual Fund. Welcome, Harshad.
Yeah, thanks, Pradeep. Good afternoon, everyone. Good evening, everyone.
Yeah. So before I hand over the presentation to Harshad, I would just try to give a backdrop to the quarter, what panned out in terms of during the earnings season. So just to bring you back to say September 2024, when the market peaked, and post that we had seen quite a lot of volatility in markets, as you can clearly see in the charts about on the left hand side and right hand side. The and this was largely to do with the uncertainty emanating on the global front, be it tariff, trade, and geopolitical flare-ups, which led to this volatility in the equities market. And this is again clearly evident in terms of what we call as volatility index or India VIX, wherein Nifty VIX is wherein the volatility in the equity market is what is tried to gauge. And clearly you can see there were quite a lot of spikes in the near term in the last few months. Having said that, on the domestic front, coming to domestic front, GDP growth was softer, predominantly due to three, four factors. One was obviously we had this general elections, which led to 6 to 9 months, wherein the government capex was slower, and only in the last quarter, 3, 4 months of this financial year, the capex really picked up. So that led to some softening. Also, credit growth was weaker. That also had an impact. Liquidity was an issue which, of late, RBI has tried to address through slew of measures, even outside of policy, and that has led to at least the liquidity issue getting sorted out. On the inflation front, on the other hand, over the last 1 year, what we have seen is inflation has significantly moderated, and that is why RBI has taken a lot of comfort from that, and we have seen quite a lot of cuts. In this year itself, CY25, there's been cumulatively 100 basis points of rate cut. Uh, uh, Prior to this quarter, obviously in Feb, there was 25 basis of rate cut. And the remaining 75 basis points, which was 25 basis points in April and 50 basis points in June, which was this month, this cumulatively was 75 basis points. So the total 100 basis points of rate cut has happened. In the recent policy, RBI has also given a forecast on inflation, which was brought down to 3.75%, 3.7% for FY26, which again gives a lot of comfort. Uh, and from that perspective, inflation has been moderating and largely due to food prices declining. So more on this, given this backdrop, I would like to now hand over the call to Harshad. Harshad, over to you on how the earnings have been, if you can just highlight. Thank you.
Yeah, thanks, Randy. And also thanks for giving the context for the earnings. Clearly, I think if you look at March quarter results, or particularly for the last 6 to 8 months, so a lot of volatility in the market, as Shrenik said, and largely to do with macro factors, geopolitical factors, and also, US-led tariff issues. While obviously it's important to, take note of this, be cognizant of, what's happening. Also, it's important to look at, what are the fiscal and monetary actions which are being taken. But at the same time, I think, see, eventually, we invest, if we look at our portfolios, we invest in the corporates and companies, right? So all this is important to know, but at the same time, at the end of the day, it is, what matters is what your companies do, how the earnings of those companies have been progressing. So I think this is what we are trying to do over the next, let's say, half an hour to 45 minutes. So we just talk about what happened in the fourth quarter. So really, I think the last 2, 3 quarters particularly. So India corporate earnings have been on a, I would say, weaker footing, largely to do with do with consumption slowdown. Also because of elections, there was a slowdown in terms of government capex. So that had a bearing on the earnings growth. So the fourth quarter which went by, we saw EBITDA growth of roughly around 7% for Nifty 50 and PAT growth of around 3%. I think while the earnings are weaker, but I think the important point is the overall, is largely in line, or I would say better than expected kind of earnings. If you look at the top right chart, so there we are looking at, what percentage of earnings were above estimate, were in line. So I think the percentage of earnings which are above estimate or in line was clearly higher in the fourth quarter. From the outlook perspective, FY 26 and 27 earnings, so while FY 25 full year versus last quarter was 3%, but on a full year basis, Nifty 50 earnings are roughly up around 1 to 2%. And over the next 2 years, I think cumulatively on a CAGR basis, we're looking at anywhere between 13 to 14% kind of earnings growth. Yeah. So as we move on, yeah. So here what I try to do is, divided the BSE 200 earning. While the earlier slide was for Nifty 50, but what we want to take more broad-based kind of, overview. So I looked at top 200 BSE 200 companies, the earnings was happening, divided into a few, key sectors. The last column on the right-hand side is nothing but the weights of the sectors in BSE 200. So basically, it gives concept of materiality, which sectors really matter. So here, if you can see, let's start with financials first, which is one of the largest sector. So earnings
Harshad,
have,
sorry to interrupt you. I think there's some technical issue. Your voice is not coming proper. So we are trying to resolve this issue. So would request all the participants to stay for at least 2, 3 minutes. We'll try to resolve this. So please stay with us. And apologies for this inconvenience. Uh, Again, apologies for this technical issue. Harshad should be joining in anytime. So, meanwhile, as Harshad was pointing out, we had this BSE 200 earnings uh, projection that earnings, how the earnings have been for last few quarters in FY24 and FY25. So, Harshad, would you like to have you? We are sorry, Harshad is trying to log in. There was some issue in terms of voice not being very clear, and because of which he is reconnecting. So, would request your patience. He should be joining in anytime now.
Yeah, Shrenik, am I audible?
Yeah, Harshad, please go ahead.
Sure, thanks. Yeah, hi. Sorry for this interruption.
Yeah, Harshad, please go ahead.
Yeah, sorry. So let's begin again. So,
Yeah.
so looking at BSE 200 earnings, if you look at financials was weaker, primarily driven by slowdown on the private bank side in terms of credit growth, but it was also a reflection of overall credit growth in the system. Within that, I think insurance has done well. It's a fourth quarter phenomenon. We'll cover that in the subsequent slides. Auto, on the other hand, if you look at was weaker. I think barring tractors, if you look at, I think autos were weaker numbers. Other than that, FMCG or consumption as a piece has been weaker. I think highlight could be, I would say, healthcare, which has moderated but still steady. IT continues to remain muted. Metals did well, particularly non-ferrous, I think has done well. And cap goods, I think, despite a slowdown in the government capex, I think overall earnings were, much better. So with this background, what we'll do, we'll cover this in more detail. So what we have done is we have basically divided the overall the earnings in different sectors. The first we'll cover financials, which would include banks, NBFCs, and insurance. Then that will be followed by consumption. Then we'll also cover export sectors like IT and pharma, and some global sectors like metals and oil and gas. And lastly, then we look at investment themes like cap goods, infra, cement, and utilities. Yeah. So moving to banks, yeah, on the bank side, if you look at fourth quarter, performance-wise or operating metrics-wise, I would say it was largely similar to 3Q because loan growth was sluggish. There was pressure on NIMs. While I think asset quality, particularly for banks, was largely in control. So if you look at top left chart, it's the loan growth and deposit growth chart. So roughly at both hovering at around 10% or so. But private banks did well. So the range was between private banks. Some banks well obviously did lower at 8%, but at the same time, large private banks, some also grew at around 12% or so. On the CASA front, I think it's more seasonality effect. March quarter typically you have higher CASA. So to that extent, QOQ CASA was slightly better. NIMs, I think large private banks did see some sequential improvement. But I think both at the aggregate level, if you look at, there was a decline both for private as well as public. In terms of loan growth, I think the slowness or sluggishness was across the product categories. It was not driven by any single segment. So the bottom left chart where you can see, we saw the weakness across the product categories. And lastly, on the asset quality, I think for the banks particularly, asset quality continues to remain strong. GNPA continues to go down. Apart from that, if you look at capital ratios for the banks, also continue to remain very good. So net, I think from the bank's point of view, a weak but inline quarter. From the outlook point of view, I think while the growth estimates on the street, everyone has moderated near-term pressure on the NIMs. I think it's largely well known. But I think the important point to note is balance sheets for all the banks, it's quite strong. Provision coverage ratios as well as capital reserve ratios are also quite strong for all the banks. While the sector or has done well in the last 6 months, valuation has moved up, but I think it's still comfortable given the strong ROE profile. So tracking much better, and it's largely, I would say, better than the long-term average both on the profitability point of view. Now let's move to NBFC. So NBFC, as you know, it's not a uniform sector like banks, right? It has different sub-segments, which include, let's say, while there are diversified NBFCs, but there are HFCs, auto financier, gold NBFCs, and also microfinance. So overall, at the NBFC level, loan growth was around 16%. Within that, gold obviously did very well, strong growth upwards of 40%, while auto was also fine, and diversified also did well. I think the highlight or the negative highlight was more on the MFI side. I think the cleanup is continuing on the MFI, but largely we believe that sector would have bottomed out. Maybe it's a matter of a quarter or so. NII growth, while obviously lagged the AUM growth, implying some margin pressure also on the NBFCs. On the NPA front, so while GNPA at a headline level was marginally better. GNPA is nothing but 90 plus kind of delinquencies, but the delinquencies were higher on the 0 to 90 bucket. That's what we saw was a broader theme during the quarter. I think higher delinquencies were largely on the unsecured front or microfinance MFI front. That's where we saw higher delinquencies. Coming to outlook, I think the loan growth for the NBFCs will be function of the underlying economic activities. So obviously for vehicle finance, it matters how the auto sector growth is. For the housing finance, similarly, so that will drive the earnings growth. But I think the rate cut, which was obviously happened recently. So as the rate cut happens, and if you look at NBFC's loan book, it's largely fixed rate. So in a rate cut scenario, NBFCs per se benefit. So I think that would play out in the coming quarters. But what we need to watch out is more on the asset quality front, particularly on the unsecured. If you look at the recent stock performance, unlike banks, where we saw uniform banks doing well, but on the NBFC side, it was mixed kind of performance. I would say it was very stock specific. So here one has to be selective. Largely we have been focusing on the NBFCs which are backed by good parentage or also have a strong asset quality history. Now let's move on to insurance. So on the insurance front, obviously two parts, general as well as life. So let's start with general insurance. So growth, if you look at the gross premium growth was moderate at around 2%. Various factors led to this lower growth. One obviously was in the accounting methodology for how the gross premium is accounted. So one by one method for non-motor long-term policies. Second, also, I think the motor segment, while it was steady, but it was primarily driven by renewals rather than vehicle sales, which obviously continue to remain low, which we'll cover. And there was also some pricing pressure on the commercial side. So yeah, growth was weaker on the combined ratio front, which obviously is a indicator of, let's say, profitability. So I think it was largely steady, particularly for multi-line private insurers. And if you look at PSU players, I think there the profitability was impacted, and it's more to do with their higher discounting, primarily, which is to gain the market share which they had lost earlier. On the standalone, I think health insurance side, the combined ratio was higher. Primarily, one is obviously the higher claim severity and the frequency of claims. I think both is impacting the profitability or the combined ratio for the standalone health insurers. In terms of outlook, I think it's more, it looks like we should see double digit or mid double digit kind of mid-teens kind of growth. Combined ratio may improve primarily due to better pricing on the commercial lines, or let's say lower nat cat losses. Also, there is expectation of price hike on the third party motor side, which will largely benefit multi-liners. I think valuations are comfortable in the range of 25 to 28 times, I would say, for the private multi-insurers. Now, moving to life insurance, again, growth declined in the fourth quarter. If you look at the top right chart, the drop was led by the lower ULIP demand. I think it is a function of market volatility. And also, if you look at a push in terms of sales push, it was more for traditional or non-par products, which was the key focus in the second half. And also, I think on the banca channel, we saw some calibration in terms of growth because their focus was more on in the core banking products. I think only agency was the one and the proprietary where which supported the growth in FY25. Coming to, I think, profitability, or let's say value VNB margins. So I think the 1H VNB, if you look at first half of FY25, VNB margins dropped primarily due to change, or let's say higher new surrender norms, and also higher ULIP mix. But I think despite growth in new business premium growth, I think the fourth quarter we saw margin recovery. I think that was primarily led by traditional savings as well as protection products. Outlook, again, I think while the growth has tapered down from earlier 17-18% to now 14-15%, primarily due to, let's say, ULIP or banca slowdown. But I think margins can see uptick because of, I would say, lower base or shift towards high margin protection or non-linked kind of saving product. I think sector has already derated to some extent due to all these regulatory and growth headwinds. I think valuations now have, I think, slightly become comfortable. But as if you look at our portfolios, we prefer general multi-liners over, I would say, life insurance companies. So now post financials, let's look at consumption as a piece. So within that, let's start with auto. So auto, again, as you know, it's more of a cyclical sector going through a down cycle right now. I would say volume growth was up. I think overall volume growth is around 2% or so. Here again, I think rural has done better than the urban. Highlight clearly was a tractor sales, which was up 17% YOY. Two-wheeler, I think here, while 1H was better, first half in FY25 was better, but second half, experienced kind of deceleration, I would say. In the fourth quarter, it was roughly around 1.5% YOY growth at overall two-wheeler as an industry. Within that, obviously, scooters has done well, which was up 7%, but the issue is more on the motorcycles and mopeds, where we are seeing decline. Passenger vehicles again 2% kind of volume growth. Within that, obviously, utility vehicles did well at around 7%. But I think near-term outlook and the commentary for the companies looks like will better, lower single digit even in FY25. CVs was up around 1%. Within that, I think bus segment did well, but overall CVs were only up around 1% or so. So overall, I think auto OEMs revenue was up around 5% on a YY basis. I think ancillaries were up around 7%, primarily obviously led by replacement demand. Tire, I think, did quite well, but I think because of raw material, there was some impact on the margins for the tire companies. Overall, I think outlook wise, I think what we are looking forward is more, rural economy doing well. So rural demand should improve. So to that extent, we should see uptick on the two-wheeler side, or I would say low-end PV side. So that's what we are looking forward to second half. So overall, I think if you look at industry body estimates, they are expecting 2 to 4% growth in passenger vehicles, single digit in CVs, in about I think 6 to 7% in two-wheelers. So while moderate outlook on the growth, I would say for the auto side. So the positioning here again, given the moderate outlook or low volume growth, the position here is more stock specific or bottom up kind of basis. Yeah. Now FMCG, while FMCG has been disappointing for some time, primarily because of lower volume growth. Again, overall it was sluggish, similar to auto. I think rural has shown actually a good improvement, but urban continues to remain subdued. If you look at the margins, the gross margin was impacted primarily by the RM inflation, particularly on the agri basket. But I think that is history. I think what has changed is that one, I think there is some cool down on the raw material side. So I think to that extent, we should see some benefit or cushioning on the margin. But I think the other issue is if you look at first quarter 1Q FY26, because of early monsoon, there could be some impact on summer heavy products like let's say beverages, ice creams, or talcum powder, to that extent. But net I think the hope is second half should be better. Rural obviously with the normal or better than expected monsoons, but urban should come back led by so different decisions which has been taken by the government, including let's say income tax cut, interest rate cut, and also aid pay commission down the line. So there are multiple factors which should drive the consumption back in the second half. From the valuation point of view, I think while the valuations have come back in the FMCG, but I think they still remain. If you try to marry growth versus valuation on the FMCG side, clearly I think there is a mismatch. So to that extent, if you look at our portfolios, we continue to remain underweight on the sector and selective out here. Yeah. I think before going to retail, let's quickly cover new age while it's an emerging sector. So here I think again because of a broader slowdown in the consumption, if you look at GMV's top left chart for the food delivery, it has slightly decelerated during the quarter. If you look at top right chart, it's about QSR growth. I think while overall consumption was weaker across the categories, but I think QSR has slightly done better, particularly in the last 2 quarters or so. Quick commerce again, as the space is getting very interesting. The growth continues to remain strong, but I think it's primarily due to the aggressiveness in terms of pricing, and also there is a lot of incremental penetration led by store expansions. Beauty again, I think is doing well. But it is more to do with reinvestment, which is driving the growth for the beauty segment. And on the digitization front, I think while the story is well known, but I think the higher penetration or sustained strong growth on the digital payments is clearly implying better implementation or adoption of digital, and which is helping overall all the new age companies. I think fourth quarter, I think nothing has changed largely apart from some slowdown in consumption. Overall, I think the new age continues to do well out here. Now let's move on to retail segment. So So retail again, demand was weak, and that was the story, I would say, of FY25 for the retail segment. While this segment includes multiple parts like apparel, jewelry, QSR, footwear. So within that, I think jewelry and QSR has done well, and footwear and apparel was weaker during the year. So as I said, value fashion, or jewelry or grocery retailers have outperformed during the year or also during the quarter. One driven by its own demand and also market share gains from the unorganized. I think this story is playing pretty well, in the retail segment, and I think it will continue to play well going forward also. From the outlook point of view, I think particularly for the consumption, I think inflation has come down and now is at a multi-year low. So clearly that would mean, higher disposable income in the large population. I think that will clearly benefit. The income tax relief, which has been given in the recent budget, I think now after 2-3 months of actual, that accruals in the, bank accounts, I think that again will start playing, out. Interest rate cuts, I think while it's early, but I think eventually large part of it will be passed on and should again boost consumption. On the rural side, as I said, things are better. Crop yields also looks better. I think rural story continues to remain strong. Come next year, I think we have this 8th pay commission, implementation. The numbers are quite large. I think various estimates include anywhere between 2 to 4 lakh rupees. So it's a big 4 lakh crore rupees kind of money which will be gone through this through the 8th pay commission. So net, I think while there is ongoing weakness, but I think outlook remains quite optimistic on the retail side. Now, coming to telecom, I think so here I think as you recall telecom, so every 1.5 year, the sector has been taking tariff hikes. So the last tariff hike after that, I think largely everything now is reflected in the ARPU. So to that extent, in the fourth quarter, there was not much increase in the sequential ARPU. I think largely it was passed on. There was also some impact of 2 lesser days during the quarter. So to that extent, there was some impact on the ARPU side. On the subscriber base, I think largely now one can say that it's largely 99% or 98-99% it is penetrated. So it's largely range bound. But I think what is changing is the penetration of 4G and 5G, or I would say data or smartphones. So that is increasing. Within that 5G penetration, I think that was quite impressive, where we saw 5G penetration now stands at anywhere between 37 to 39%. So while I think if you look at from the earnings point of view, while the ARPU was largely flattish, but going forward as we see better 5G penetration, and now I think companies are also thinking of kind of monetizing this 5G. So to that extent, we will have better profitability going forward and also will be reflected into ARPU. From the outlook point of view, while I think from the subscriber base, there's not much to look forward to, but it is more about, I would say, it is more about data penetration that will kind of play out in this sector, and which will also mean data penetration plus the tariff hike, which again is expected down the line. Because if you look at our per capita spends on the telecom, so compared to other countries, obviously it is much lower, and there is some room for it to increase going forward also. So on the real estate front, I think so after after a decade's kind of sector remaining flattish, sector has come back in the last 3-4 years. So particularly if you look at fourth quarter, we saw overall 8% growth in the pre-sales value for real estate developers. So this 8% compares to overall industry growth of 4%, which means the top players or the large listed players have gained market share in the top 7 cities, and which has also happened after RERA, where we saw local developers moving away. On the pre-sale side, overall it was 11% growth, 11% growth in the average realization, but the volumes dipped at around 3% to roughly 29 million square feet. I think net the story is operating cash flow continues to remain healthy, 20% growth YOY, and this was primarily led by, let's say 18% growth in collections. Now, from the outlook point of view, I think demand continues to remain strong. While I think now after the stocks have moved up in the last few years, the valuations now seem to be reasonable for now. So here again, one has to be very stock specific. Now let's move on to quickly to consumer durables and also building materials. So within consumer durables, I think if you look at the numbers on the left hand side, so wires and cables has done quite well, primarily driven by power generation as well as transmission. And also I would say early summer has kind of drove the wholesale sales, or let's say channel filling for the summer products like AC, fans, coolers, etc. But I think 1Q will again expected to be weaker because of early rains. I think so. The story will be different in 1Q versus 4Q. Coming to building materials, as you know, it's a late cycle beneficiary of the real estate or the new houses which are getting built. So I think whatever the new houses which have been built or bought in the last 2-3 years, I think 1 or 2 years down the line, all these houses will start getting delivered, and we should see demand for this. So coming to FY25, the year gone by, I think the overall demand was weaker for building materials. I think one of the reasons was obviously higher inflation, which impacted the renovation demand. But I think as the inflation moderates, renovation demand should come back, and we are expecting from the second half of this year, the real estate tailwinds, should benefit the building materials. Within that, I think plywood and MDF has outperformed, but I think that is more to do with the market share gains by the unorganized player. So net, I think on the consumption piece, whatever we discussed, I think it's more the macro steps which government has taken, the steps taken by RBI to improve the liquidity. I think all this is expected to play out in the second half. That coupled with monsoon as well as festive season. Now let's move to global sectors. Let's start with IT. So here again, I think the growth was impacted, or is, I would say, in the near term there is uncertainty led by tariff issues in US. IT, as you know, almost anywhere between, I would say, 60 to 75 or 60 to 80% of earnings are US dependent. So within that, if you look at top left chart, so we are trying to bifurcate between growth for tier 1 and tier 2. So tier 2, I think it was quite resilient in terms of growth, but the only issue is that growth has come at the cost of some margins and weaker cash conversion. Secondly, guidance which all IT companies give, so that has also weakened. Then the primary reason for the weaker guidance is because of the delayed decision-making environment, particularly in the US. If you look at top right chart, it's more growth, which we see good uptick on the BFSI front. But I think that is this uptick is getting offset by uncertainty on the tariff side, policy side, and also it had hit other verticals like I would say retail, manufacturing, healthcare, which are big verticals, almost contribute to upwards of 40-45% of top four IT companies, I would say. Bottom left chart, it's more hiring, which is a reflection of business growth. So hiring continues to remain muted. Particularly companies are focusing on improving the utilization, basically reducing the bench strength, and focus is more on optimizing the cost in the current weaker demand environment. On the margin front, I think margins was largely range bound but weaker. Net, I think I would say IT outlook is muted for now, but valuations have factored that. So to that extent, I think we are largely a neutral stance on the sector, and let's wait out how the US policy decisions pan out. Now coming to pharma, I would say so the business saw some India business particularly saw some dip in the growth, but it's more because of seasonality and some probable impact on the trade generics. However, I think the chronic focused companies, as always, continue to deliver market-leading double-digit growth. On the other hand, I think the acute companies reported in line or marginally lower than I would say IPM growth. While India, while it was softer, but I think it was offset by a steady growth in the export markets, particularly led by US, where I think pricing environment is largely steady. On the healthcare front, which basically is nothing but hospitals and diagnostics. So on the healthcare front, I think we continued to saw volume growth backed by, I would say, capacity additions. EBITDA margins were largely steady, I would say, despite bed additions which happened. And overall, I would say the better mix or better pricing is helping hospitals as a segment. On the diagnostic side, steady volume growth. Margins were more driven by center additions. And I think what is also happening is that overall, increasing share of wellness portfolio across the players, kind of going through bundle tests and all. That is also improving overall on the diagnostic side. Net, I think both pharma, particularly there again, one has to be stock specific, and healthcare, while I think valuations are higher, but I think the runway for growth is clearly longer. So I think as a house, we are overweight on the pharma piece. Now, other global sectors, let's cover metals first. So here I think both ferrous and non-ferrous. So while on the steel side, the weak prices dragged the realization both YOY and QOQ. On the non-ferrous, the realizations were strong. But as you know, while that was the story of the fourth quarter. There I think margins were weaker. But as you know, because it's a global sector, what really matters is what's happening currently. So here I think after the the anti-dumping duties which have been put, I think sector has pricing has done well, particularly on the ferrous side, and that coupled with coking coal prices going down. So I think sequentially in the near term at least we should see ferrous as a piece doing well. I think on the non-ferrous, particularly aluminum, there is some decline on the LME prices. I think gone down from 2600 to 2400. So I think non-ferrous could be weaker, but ferrous I think will continue to do well. So net, I think valuation wise, I would say largely fair valuation, but this is a sector where one needs to be cognizant and on the top of it. And basically it's more of a tactical kind of play. So for now, I think it is fine. Margins are supportive till the time there are anti-dumping duties, and the prices in India are better despite weakness on the China side. Yeah. So moving to oil and gas, again, sector includes downstream OMCs, upstream ONGC, Oil India, and the gas names. So within that, I think the refining, while the headline GRM or Singapore refining margin, which everyone tracks, so while it was lower, but I think all the OMCs reported good refining margins. And as you know, the story for the OMCs is that the pricing, while on the paper it is free, but again, it has been frozen for quite some time. So to that extent, lower international product prices, which means at the same price, they can make higher marketing margin. So I think that's what is happening. If you look at full year FY25, there were losses on the LPG front to the extent of roughly 40,000 crore. These companies are still waiting for the compensation, but till now nothing has come through. But despite that, I think the numbers were better, primarily because of higher marketing margin. That's on the OMCs. On the upstream front, I think it's largely a function of oil price. I think till the time if the oil prices move up, I think upstream will do well. In the fourth quarter, which went by, I think marginally weaker because of lower crude realization, and also because the gas realizations were capped at around $6.50 per MMBTU. On the petchem side, which is that there also I think deltas are weaker, but largely flattish on a sequential basis. On the CGD front, if you look at, I think there is the CGDs have taken some price hikes to pass on, APM deallocation. But at the same time, the higher LNG prices is impacting its overall profitability. But net, I think to push to CNG at a country, remains. So I think CGDs as a whole should continue to do anywhere between, let's say, 8 to 11% kind of volume growth going forward. So sector remains obviously, given what is happening on the energy side, impact of EVs, impact of renewables. So sector remains, I would say, from the short term point of view, because of valuation, one might, we have some exposure out here. But from the outlook perspective, we need to clearly watch out, what's happening on the policy front. Now moving to cap goods, I think FY25 particularly, because of elections, the government capex had slowed down. March quarter, we're looking forward for the capex to restart. I think that has happened. So we saw, government once again spending in the March quarter, and that is reflected in the numbers. So we saw order inflow, particularly on the power T&D, renewable energy, data centers, real estate, and defense, where there was a healthy traction in terms of order inflow. While I think on the private side, we are still waiting for the pipeline, on the cement, steel, and petrochemical. I think maybe 1 year down the line, we should see some uptick out there. Margin performance was mixed. But what is happening is that the legacy projects, which were low margin projects, so the share of those legacy projects is going down. So to that extent, margins are improving. International book also, remains quite strong. Unlike earlier years where it was largely a function of only oil price, I think incremental, I think that is not the case. I think that book will continue to do well despite, wherever the oil prices are. From the outlook point of view, I think, see, last year, there was a lot of froth in terms of valuation. I think now with the correction which has happened in the last 3 to 6 months, the froth has reduced in the sector. But again, I think it's not nowhere near, historical averages. So one needs to be selective out here. Yeah. So lastly, I think cement. So cement again, 4Q was a good quarter for the sector. We saw volume grow to the extent of 12% YOY. I think two factors. One is obviously demand and low base that has helped. On a full year FY25 basis, volume growth was again muted at around 5% or so. But I think despite, different factors like summer impact, then there was some, slowdown in the construction because of pollution concerns. Despite that, I would say a decent performance of, cement in the fourth quarter. Margins improved, driven by some improvement in the realization and lower OPEX. EBITDA per ton or EBITDA profitability also improved. I think in the second half, while monsoon, demand will be weaker, but second half is expected to do well. Overall, I think, if you look at industries, different management, so they're expecting industry growth to the extent of 6.5% or let's say 7 to 8% versus 5% in FY25. Pricing front, I think whatever we gather, prices have improved on a pan-India basis. If you look at sequentially now, I think they are further up around 3% or so. While I think near-term story is quite good, but in the medium term, one needs to be careful or watch out on the overall capacity additions which are happening at the same time. There is a news flow in terms of potential increase in the limestone royalty. So over here again, while the valuations are not cheap, but I think they are, I would say, reasonable depending on the outlook and the profitability. So here again, if you look at our portfolios, we are playing it largely through the top large cap names within the sector. So I think that was largely, on the fourth quarter, if you look at sector wise. Now, I think the key question one needs to address is, how, hence, okay, it's fine, the earnings were weaker in the third quarter, fourth quarter. So what's the outlook going forward? So here we have some thoughts, so let's start with, few things which we believe, will improve the earnings going forward. So one, as you know, government on the fiscal side has been quite disciplined. Be it, fiscal glide path in terms of reduction of debt, or at the same time, government has recognized this year that versus last few years the focus was more on infrastructure spending and capex, but consumption had taken a backseat. But this year there was good incentive which was given, so anything below, as I think anything below 12.5 lakh rupees, there is no tax. So it's a big boost, I would say, in terms of disposable income in the large population. Secondly, I think the monetary policy has been quite supportive. YTD we already have seen after the last 50 basis point cut, already seen 100 basis point cut. I think as over the coming months we will see this rate cut getting translated into lower EMIs, and to that extent again should boost demand. Liquidity was one of the issue, I think, that has been addressed big time by the RBI through various measures. Secondly, I think oil price, which is very important from the India point of view. So that continues to, remain low. So to that extent, I think it's a big positive for the economy as a whole. And lastly, I think the DI or FII, buying and selling. So which, while DI has been quite supportive, but FII, as you know, were sellers towards September, October last year when the valuations were high. But I think if you look at last few months, driven by, I would say, uncertainty on the US front, we are seeing, FIIs coming back. So I think all the building blocks are, very much there in terms of recovery to happen. That coupled with, as I said earlier, normal monsoon festive season in the second half. So we are quite hopeful in terms of, earnings should, do well. Now, if you look at Nifty 50 earnings, so here we are tried to, so these are Bloomberg consensus numbers in terms of sectoral earnings growth. So while as you can see, FY25, these are the absolute PAT numbers. FY25 was weaker, but come FY26 and FY27, we are seeing earnings growth driven by multiple sectors. As I said initially, from FY25 to 27, the earnings CAGR is expected to be around 13 to 14%. So clearly markets or consensus expectations, whether the answer of whether the earnings have bottomed out or not, I think maybe 1Q, while it will benefit from the base effect, but I think the second half of FY26 we should see earnings growth coming back, led by different factors which I just said. Now, this is just taking an overview of in terms of sectoral performance, what has happened in the last 6 months, 1 year, 3 year. So let's look at top line, which is on a yellow color line, the 3-year chart time stock performance, right? So initial stock, sectors like cap goods, realty, PSUs, and all these has done pretty well on the last 3-year basis. But again, if you look at last 6 months basis or 1 year basis, all these were laggards. So clearly, I think wherever there was froth in the valuation, I think some part of it has already corrected. But unlike, I would say, the way market was, let's say 3 years back, where one could have taken sectoral bets, but I think now market is not same. One has to be stock specific, or one has to have a bottom up approach while building the portfolio. From the valuations point of view, I think if you look at top left charts, what we are trying to do is look at the 1 year forward valuation for mid cap as well as Nifty. So Nifty clearly is trading at around, I would say, near to long term averages. This is 1 year forward on FY27 basis. I think it is trading I think marginally below long term averages, while mid cap continues to trade at a premium versus long term averages. And on the top right chart, is a premium of mid cap versus Nifty. So there, I think there is some room for normalization for mid cap valuations vis-a-vis large cap. But within that, I think large cap remains reasonable. Bottom left chart is more about ROEs. I think we are back to, while we are not back to historical highs, but I think we have taken a decent up move from a single digit ROE for a Nifty companies. Now we are back to a decent number of 15-16% ROE. Yeah, so I think to summarize, as I said, the fourth quarter, while it was weaker, but I would say largely inline numbers. we are expecting earnings to revive, while not necessarily in 1Q, but maybe in the second half, led by tax relief, rural recovery, festive period. I'll not repeat. So different factors, let's say EdPay commission, and plus most importantly, I think base effect will start playing out this year. On the macro front, I think clearly India stands out, vis-a-vis, other investable countries. So while on the US, Europe, China, there are different issues, different uncertainties, primarily again the geopolitical issues. But if you look at domestic macro, I think we have inflation in control, CAD in control, debt in control, foreign reserves in control, in good foreign reserves. So to that extent, I would say macro is quite stable, and that coupled with fiscal, I would say prudent fiscal, plus good support from the RBI monetary side, I think there's nothing to complain on the macro front. It is as strong as it can get. In terms of medium term growth levers, again, we have tried to look at different sub segments which could drive consumption. Obviously, I think discretionary is the space to look forward to. Digitization, I think post pandemic, I think the focus on digitization by the government has helped quite a lot, and different businesses, as you would see. Financialization, I think we have just scratched the surface, long way to go out there. Formalization, as I said, in many sectors, well, the industry growth was lower, but the large organized players saw better growth. So to that extent, formalization is playing out quite well. It was supposed to happen post GST, but obviously those things take time. But now we are clearly seeing the benefits of formalization. Housing, as I said, has come back and is expected to do well. Manufacturing, I think that's again story, big story after consumption. If you think from the India point of view, it's China plus one, PLI, what are different schemes which government is doing. And last but not the least, I think the robust balance sheet of India Inc., right? So what we are hoping is 1 year down the line, we could see private capex coming back. For do the capex, you need a strong balance sheet. I think it is very much there, and that coupled with also strong balance sheet of the banks. So growth levers are very much intact, I would say, from the India story point of view, in the coming period. India, again, as I said, demographics is favorable, political stability is very much there. Government has spent quite a lot on the infrastructure in the last few years. And then China plus opportunity, I think, will start benefiting. Reforms, I think many reforms have been done. I mean, I will not repeat, including GST, RERA, bank reforms, multiple reforms have been done. On the valuation front, I think the recent rate cut, which has happened, let's say 100 basis point, obviously that one is supportive. Large cap, as we showed in the chart, is now trading at similar to long-term averages. So while mid cap, is slightly premium, but one has to stick to bottom-up approach. So from the funds point of view, I think our recommendation is, we prefer large cap, flexi, multi, and hybrid funds. And obviously, needless to say, one has to follow disciplined asset allocation approach while investing. Yeah. So I'll take a pause here, and if anyone has questions, we can cover those. Thank you.
Thank you, Harshad. It was quite comprehensive and insightful. Hope our viewers would have benefited out of it. Harshad, one of the questions from the participants is on the IT sector. What is the outlook going ahead, given the uncertainty that we are seeing in terms of US, China, and everywhere? So how do you see the growth in that sector?
No, I think clearly what is happening is that the decision making, is getting delayed on the IT front. So if you look at, recent commentary or guidance by the company, so many companies have cut the guidance. So what we need to, wait for is some clarity on this, tariff issues. I think we are seeing resolutions. I think the news flow suggests that, the deal with India, China, around the corner. So I think once that happens, we should start, again seeing growth. But till the time it happens, I think it's more about, if you look at kind of projects which these companies are getting, so these projects are more about, cost cutting, rationalization projects, and not really transformational projects. So to that extent, both quality of projects is getting impacted, which has the impact on margins, and then obviously the longevity of growth is getting questioned. But I think it's a matter of time. I think if you ask me from the valuation point of view, I think all this uncertainty is largely, I would say, into the valuation. So one has to, really wait for, the policy issues in US to get resolved.
Right. Another question from Mr. Karthik Naik is what is your view on aviation, if you can highlight? Given the oil prices, they're coming down. So, from that perspective, do you see this sector being positive going ahead?
Sure. So clearly, I think the aviation per se, if you look at India's story, historically, I think upwards of 18-20% CAGR growth, number of airports have doubled, and clearly it has a network effect. But that's the macro thing. If you come down to companies, and there are not many options, we just have one. So here I think utilization levels continue to remain high, upwards of, I would say, 80-85%. If you look at the profitability per unit economics, the profitability continues to remain high. That coupled with oil prices, being lower, that also helps. So for now, I think story is quite strong. Globally, there is a issue in terms of, new aircraft supply. So the incumbent, or let's say the largest domestic player, I think they have a good supply of new aircrafts coming in. So to that extent, they are in a better place to capture incremental demand. But from the valuation point of view, I think large part of it, I would say, is already into the numbers. But the only issue in case, the only issue here is that, the how the network effect plays out, that one needs to see. We get surprised by the network effect in the other segments. If similar things, plays out here, then clearly I think there is a long runway even for this sector. And oil price obviously helps. Obviously, the story would be different if oil were to be at 90-95. But for now, with oil between 60 to 70, I think not much to worry, I would say.
Sure. Uh, One of the questions from Mr. Farhan Sheikh is are you seeing an end? Are we nearing an end in terms of market correction given the earnings getting bottomed out, or we are still to see some more correction happen?
Sure, I wish I knew the answer to that. I think the point is one can't really predict, whether markets have bottomed now. If you look at volatility, right, in the last 6 months, we saw up move and down move up to the extent of 7 to 8% in the markets. The markets are quite volatile. But I think as an investor, what we should really focus on is more about, are we comfortable, in terms of earnings growth, in terms of companies, what we are investing in, vis-a-vis what valuation they are trading at. So the whatever different points we try to make is that clearly from the earnings point of view, we believe that maybe in a quarter or two, we should start seeing earnings again coming back. The weakness in the last year was mainly driven by consumption and urban, right? So I think that piece with different government measures, liquidity, interest rate, or loan rates coming down, I think that is getting addressed. So I think at the headline or macro level, one can comfortably say that demand should come back in the second half. So to that extent, earnings should again do well. I think barring any new geopolitical issues or anything from Trump, one should not be that worried now, I would say. But from the market, I would say, from the returns point of view, given the valuation, I mean, if you look at the headline valuation, obviously it is similar to long-term averages, but not cheap. So to that extent, one has to slightly moderate the return expectations, at least for this year.
Sure. Sarvesh Lotlikar has asked, what is the asset allocation for next 1 year? How would you broadly give in terms of, say, equity, debt, commodities? How should one define a broad allocation, keeping aside the risk appetite, risk profile of the investor?
No, I think so. If you look at our hybrid funds, right? So one of the hybrid fund we have is multi-asset, which has all these three asset classes which were asked: equity, debt, as well as commodity. Commodity within that is primarily gold and silver. So there, if you ask me, current allocation, we are roughly at around 50 to 53% equity. The difference between 65 and 53, because it's equity taxation, we need to have 65% equity. So that 12% is arbitrage. We roughly have 10, 12.5, 13% commodity, and the rest is debt. So yeah, 53% I would say cash equity, 12.5% commodity, then rest is arbitrage and debt. So that's the allocation. But if you look at last 6 months, we have moved equity allocation. So last year, somewhere in July, August, we were roughly at around 58%, went down to 46, 47, and now we are back to 53. But that is what we do in hybrid funds where we have flexibility to change. Yeah, at a individual level, one obviously has to take a call based on his own risk appetite.
Sure. So I think hybrid funds, as you clearly mentioned, in terms of asset allocation as well as tax efficiency, they clearly rank right up there. So someone who doesn't have the appetite, the time horizon, and the expertise can obviously look at these funds from a automatic asset allocation, which is taken care of by an expert. Harshad, moving to next question. One of the participants has asked us, is there any contrarian view that you're seeing in in terms of any opportunities that you are seeing going ahead that this particular pocket uh, can offer going ahead in case if the scenario plays out?
See, one can say those things more on the hindsight, but I think if you look at our own, let's say last 12 months, right? Let's not go beyond that. So there, I think we had taken some contra call on the pharma, where people had issues in terms of uncertainty on the US and all. But there, I think we're confident, and we had gone overweight out there. So that's one. Long back, I think let's not go 3, 4 years back, we had a large overweight on the financials. While it took time to play out, but I think that has helped eventually. Right now, if you ask me, so consumption as a piece is going through weakness, right? So to that extent, one can expect eventual mean reversion by various factors which we mentioned throughout this webinar. So that piece can discretionary can be looked at contra as of now.
Sure. Uh, there's one question from Nikhil Shah, wherein what is your view on dollar index? Are the crude prices going to stay here at these levels, or you would see a reversal in the crude oil prices? Any views on that?
No, I think frankly not expert in this because as you know, dollar index has been moving as per the tweets of Trump, right? And on the crude side again, while OPEC has been trying hard to kind of reduce the growth in the US shale production. So there are multiple factors which are in the play here, both for DXY as well as crude. So yeah, I think no clear-cut view, I would say, I mean, if you want to answer.
Sure. Any views on hotel sector?
No, I think see sector. See, it's a function. I mean, similar to airlines, which has done well. So post COVID, clearly we saw economy moving towards experiential economy, right? So to that extent, and it is both domestic as well as international. So for now, I think sector is doing well. Occupancy rates are very high. We are seeing see there is a also issue in terms of supply in the premium or luxury side. I think that is getting addressed. So for now, I think given that people want to spend, people want to go out, and then if you look from the 3 to 5 year story, the discretionary income or let's say per capita income will keep on moving higher. So to that extent, I think it similarly boils down to one is overall sector demand, which I believe should continue, but also it boils down to efficient operator, right? So both these factors are important, and one should not just look at the top line growth because one should also be prepared for one should also be prepared in case of there is a slowdown. So who is the last survivor or the low cost operator within that. So multiple factors, but I think overall for now I think sector is doing well.
Sure. You mentioned that we had taken this call, a contrarian call on healthcare. What is your view currently on the healthcare as an entire sector, and any specific pockets that you are preferring more over the others?
No, I think, see, one of the issue in the last few months was, some adverse, impact from the anything on the US tariff side. So I think our view was that, one, we are one of the lowest cost producers. If you look at the story in US in the last few years, so a lot of generics players or generic factories in the US were closed down. So to that extent, dependence on India obviously was higher. So we were not too much worried on the tariff front, because if tariff were to be put on, Indian generic players, the eventual burnt of that will be on the US consumers. Because for us, we will obviously have passed it on to the extent of, 80-90%. So I think that's one. So there are multiple themes, which are playing out within the pharma. You can look at our portfolios wherever, we are overbid. But the call was more, we were not too worried on the US front. Domestic, I think, obviously continues, but obviously some weakness on the domestic front out there.
You touched upon the tariff thing. Now, US and China, of course, are in negotiations, and we don't know if they reach to an agreement there. So, in case if the scenario plays out wherein they reach to a amicable agreement, uh, do you see any impact on India in terms of FPI flows?
No, I don't think so. So if you look at manufacturing capacity, right? So we are minuscule versus China. That's point number one. I think the process of, de-risking away from China, whatever happens on the tariff decision, I think that process will continue. One of the success story for us, is on the electronics manufacturing thing. As Apple has been using India as its base. We are also going to see semiconductor factories coming in India. And from the FDI flows point of view, I think we are hardly, got anything in the last few years if we are to compare with China. So to that extent, for us, I think the direction to go on the manufacturing side is nothing but up. One of the reason, if I were to say, is that if you look at the share of manufacturing in India GDP, so right now, let's say it is around 14-15%. If you go back a decade, go back 2 decades, the share is similar. This, if you look at the stories, in other East Asian countries apart from China, like Vietnam, Indonesia, Thailand, so there everyone has benefited from the manufacturing, but for India it has been elusive for quite some time. But now I think with the government PLI scheme, with this China plus one, I think I would say we should benefit. We have all the building blocks. I think this is not the place to discuss too much in detail, but I think we have all the building blocks very much in place for us to, do well in manufacturing.
Sure. So, Harshad, you mentioned that mid caps are trading at an elevated valuation, as in terms of versus large caps, as well as versus their own historical average. Are you seeing any pockets of opportunities within that, say mid and small cap? Can one look at different segments within that, which are still which look interesting to you?
No, I think, see, while in such kind of webinars, we do talk of mid, small, and large, right? But eventually it's more stock specific. And second important part is, if you look at, let's say, the number of sectors which get representation in Nifty 50, or let's say top 100, number of sectors which get representation in mid cap, number of sectors which get representation in small cap. So the number of sectors are very less in top 100, and it keeps on increasing as we move on to mid cap and small cap. And typically, those sectors, so for example, capital goods, right? So large number of capital goods companies are part of mid cap and small cap. So there are many sectors, let's say building materials or retail. So all those, many of these high growth, so-called high growth companies are part of mid and small. So it's not a question of whether I should only invest in large cap, mid cap, or small cap. It's more about sectors wherever you want exposure and wherever you are comfortable. So you'll obviously invest in those. And frankly, all those high growth sectors, majority of the high growth sectors, I would say, happen to be in the mid and small. So one can be worried at the index valuation level. But I think if one wants to exposure for these different high growth, for example, let's say capital markets, right? I mean, the stocks have done well in the last few years. So all those names were part of mid and small, not part of large cap, right? So I think long story short, it's more stock specific than mid versus large versus small.
Sure. So going ahead, at least we'll have to be more bottom-up story
Yes.
than looking at a broader sector level. Say,
Yeah.
if you can just focus on a particular sector, you would be done. Coming to the next question, Harshad, any views while you touched upon auto in detail in terms of two-wheelers, OEMs, ancillaries? If you can just repeat for the benefit of viewers, what is your outlook on these three segments?
So I think passenger vehicles expected to be low single digit growth this year. Two-wheelers, I think second half expected to be better. Two-wheeler particularly, is a function of how the rural economy does to large extent, I would say. So there, I think things are, look quite bright. So we would expect, two-wheelers to do well. Tractors, as I said, last quarter also grew, good double digit, 17%, as long as, the rural economy is doing well, particularly better MSP, better, crop yields. So I think that segment should do well. So sector, obviously it's not homogeneous, but different pace of growth, I would say, for all the three subsectors. And over and above that, there is also the issue of penetration of EV, right? Which is both applicable for passenger vehicle as well as two-wheelers. I think in this context, if you ask me, valuations obviously have moved up for the sector. So to that extent, if you ask, last year we were decent overweight on the sector. Now with valuations moving up, so we have cut our exposure, and incrementally again, answering the same way, it's more stock specific. But from the where we are in the cycle, I think we are X of tractors. I think we are largely at the bottom of the cycle. Coming in the coming period, with a lot of income in the hands of people, we should see the sector to do well in the coming period from the volume growth point of view. One of the other
Harshad,
issue in the sector was also, if you look at the prices, both of two-wheeler and passenger, driven by this insurance and all. So prices had increased quite a lot. So you also need to give some time in terms of incomes to catch up. So all this has led to some slowdown. Going forward, I think we should do well.
sure. So another related question is, how's the EV story panning out? Do you see a good potential in this segment?
No, I think on the PV side, passenger vehicle side, I think one needs to wait because it is also a function of infrastructure, right? Charging points and all. I think on the two-wheeler or three-wheeler side, I think it is panning quite well. We are seeing, decent products from the companies, and economics obviously, seems to be fine. In other countries like China and all, but I think there is also a function of government incentives for that. But I think yes, penetration should happen, but obviously not at the pace what sector had feared 2 3 years back. I think it will be steady penetration which should happen. But PV, I think it's more for it will largely driven by the infrastructure rollout, how it pans out.
Sure. Harshad, very cliche question. How should one invest at the current juncture? Is it through STPs, SIPs, or lump sum? Or if someone has to go for STP, SIP, what should be the time horizon?
No, I think see, I think the easy answer is to say, spread it over 3 months or whatever, 3 to 6 months. But the point is, I think if you look at last 6 months, right, from the earnings point of view, earnings were quite weaker. Valuations, while again are not cheap, but obviously are not as costly as they used to be. So in this context, I think if the earnings growth were to come back, let's say in the second quarter and third quarter, then I think market should do well. If earnings growth really comes back the way we have been articulating that we expect earnings growth to come back. If our view pans out, then markets should do well. I think to be on a safer side, I would say spread it over 3 months. But beyond that, frankly, I don't have much of a insight on that. But if one really wants to invest, one can, from the hybrid funds at least, I would say one can do a lump sum investing on the hybrid. But X of hybrid, I think selectively one can spread it over 2-3 months.
Sure. So, Harshan, we will take one last question here. In terms of what is your view? While you talked about consumption, discretionary and non-discretionary, what is your long-term view on this segment? Which segment is going to do well, and what would be the drivers for the consumption as a space?
Sorry, you are saying discretionary as a segment?
Consumption overall as a segment.
No, see, consumption has different subparts, right? We also include auto into that, then discretionary, which includes, let's say, QSR, retail, jewelry, footwear. Then also we have building materials or, let's say white goods. So multiple segments, but I think the clear driver for all this is, discretionary income at the hands of the customers, right? I think from that perspective, if you look at India's story, one, with population growth slowing down, we are going to see per capita income rising. That's point number one. Secondly, as you know, from the India point of view, it's not just one homogeneous country, right? So we have different segment within India. We have different Indias, right? So there, I think what we saw in the last 2-3 years. So clearly, there is so much demand for discretionary. While there was a slowdown in the last 1 year, one of the other issue for slowdown was also, some curbs by RBI on this unsecured lending. I think which now has, I think I would say largely, been not there. So all these factors had led to slowdown. But I think as as the credit becomes available, as the discretionary income in the hands increases, as those income tax benefits starts percolate, as this aid pay commission, there are different angles to this. I think as this happens, I think discretionary as a piece should do well. Consumption, which includes all the broader segments which I just spoke about, I think it's not a 1-2 year story. According to me, it's more of a, I would say, 3 to 7 year story. As I said, a lot of houses which are being built. I think the number is upwards of 6-7 lakh houses which newly being built in the last few years. So as they get delivered, we'll see demand for all these building materials and white goods kind. So I think the net consumption story is quite strong. Long story short, if you ask me. Yeah.
Sure,
One
Harshan.
has to be stock specific. I mean, that's
Sure,
what it
sure.
is.
Thanks for answering all those questions. Any closing remarks,
No, I
Harshan,
think we have taken
would like?
enough time. Let's close it.
Sure. Thank you, viewers. Thanks for joining into this webinar. We look forward to your participation going ahead. Look forward to this next webinar, quarterly webinar on earnings, which we'll be doing 3 months post the earnings. Yeah. Thank you so much.